Right now, thousands of intelligent people are losing money in the stock market batch, and it has nothing to do with market crashes or bad luck. Here's what's wild. Most of these investors have read the books, they've done the research, they understand compound interest and asset allocation. Yet they keep making the same devastating mistakes over and over again. Why? Because understanding personal finance investing and actually making good financial decision making are two completely different things. And today, I'm going to show you the exact psychological trap that's destroying your portfolio, and more importantly, how to escape it. Stay with me, because what you're about to learn changed everything for me. Look, I need to be honest with you. For years, I thought I was a rational investor. I had my spreadsheets, my analysis, my rules, but then I'd watch a stock drop 5%, and suddenly all that logic would disappear. I'd panic sell at a loss. I'd FOMO into trending stocks. I'd hold on to losing positions way too long because I couldn't admit I was wrong. Sound familiar? Here's the thing. This isn't a discipline problem, it's a design problem. Your brain literally wasn't built for wealth-building strategy, and until you understand this, you're going to keep losing money no matter how much you learn. Let me explain. There's this Nobel Prize-winning psychologist named Daniel Kahneman who spent his entire career studying how humans make decisions, and what he discovered changes everything about investing. He found that our brain operates using two completely different systems. System 1 is fast, automatic, emotional. It's the part of your brain that makes you jump when you hear a loud noise, or panic when you see your portfolio drop 10% in a day. System 2 is slow, logical, deliberate. It's the part that does math, plans for the future, and analyzes risk rationally. Now here's where it gets interesting for long-term investing psychology. When you're reading about investment strategies in a calm environment, you're using System 2. You understand diversification, you know you should buy low and sell high, you get the concept of compounding interest, but the moment real money is on the line, the moment that chart starts moving, System 1 takes over, and System 1 doesn't care about your 10-year plan. It cares about survival, and it thinks a 5% drop in your portfolio is a life-threatening emergency. This is why you know what to do, but you can't actually do it when it matters. But wait, it gets worse. Because there's another researcher, Richard Thaler, who took Kahneman's work and applied it specifically to finance. And what he discovered is absolutely mind-blowing. Thaler found that we don't manage money as one unified system. Instead, we create these mental accounts based on emotion. Let me give you a real example. Imagine you receive a $1,000 bonus at work. Now imagine you win $1,000 in a lottery. Same amount of money, right? Wrong? Studies in behavioral economics show that people treat these two piles of money completely differently. The bonus feels like serious money. You're more likely to save it or invest it conservatively. But the lottery win? That feels like fun money. You're way more likely to take risks with it, even though it's the exact same $1,000. This is called mental accounting, and it's destroying your portfolio management strategy without you even realizing it. Here's where this gets dangerous for your investments. When you make a small profit, System 1 screams, "Lock it in before you lose it," so you sell, even though the investment still has massive upside potential. But when you have a big loss, System 1 says, "I can't accept this loss, it's not real until I sell." So you hold, even though the investment is clearly going down. This is loss aversion in action. And here's the crazy part. Research shows that the pain of losing $100 is psychologically twice as intense as the pleasure of gaining $100. Your brain is literally wired to make you a bad investor. You're not managing money based on logic or probability. You're managing it based on how it makes you feel in the moment. And feelings are terrible at investment risk management. Now I know what you're thinking. Okay, I get it. My brain is working against me, but what do I actually do about it? This is where it gets practical. Because once you understand this system, you can design around it. You don't fight your emotions. You remove their ability to make decisions in the first place. Let me show you exactly how. First, strategy. And this is directly from Kahneman's research. You need to force System 2 to make decisions before System 1 gets involved. What does that actually mean? It means you create rules when you're calm, and you follow them when you're emotional. Here's how I do it. Before I make any investment, I write down 3 things: my entry price, my exit price if it goes up, and my stop loss if it goes down. I write these numbers down physically, and I commit to them before I invest a single dollar. Why does this work? Because when I write those numbers down, I'm using System 2. I'm logical, I'm calculating probabilities, I'm thinking long term. But when the market moves and System 1 tries to panic, I don't make a new decision, I just follow the rule I already made. I've removed emotion from the decision-making process entirely. This is how professional traders actually work. They're not more disciplined than you. They just don't let their emotions participate in financial decision-making. Second strategy. This one's from Thaler. You need to stop treating different money differently. Remember mental accounting? Here's how to fix it. Look at your entire investment portfolio as one unified system. Not the stock I bought last week versus the index fund I've held for years versus that crypto I'm down on. Just one number. Total portfolio value. When I stopped tracking individual positions and started tracking total performance, everything changed. I stopped getting emotional about single stocks. I stopped holding losers because I didn't want to realize the loss. Because here's the truth, money doesn't have emotion, it only has effectiveness. A dollar you made from dividends is identical to a dollar you made from capital gains. A dollar you lost on Tesla is identical to a dollar you lost on real estate investment trusts. Once you see this clearly, you start making rational decisions about portfolio management strategy instead of emotional ones. Third strategy, and this is the most powerful one, you design your environment so emotion doesn't get a vote. Let me explain what I mean. How often do you check your portfolio? Every day? Multiple times a day? Every time you look at those numbers, you're activating System 1. You're creating emotional reactions. You're giving your brain opportunities to panic or get overconfident. Here's what changed my investing completely. I check my portfolio once a month. That's it. I have automatic investments that go out every 2 weeks. I have clear rules about when to rebalance. I have a written investment policy that I review quarterly, but I don't look at daily price movements. Because daily price movements activate all the cognitive biases that make me a worse investor. This isn't about controlling your emotions. It's about designing a system where your emotions don't have the power to destroy your wealth-building strategy. Now here's something most people miss about emotional intelligence in finance. It's not about being cold or robotic. It's about understanding that your feelings are giving you bad information about probability. When you see a stock drop 15% and you feel panic, that feeling is real. But it's not useful information for investment decisions. Your System 1 brain is treating a temporary price drop like a permanent disaster. It's trying to protect you from a threat that doesn't actually exist. The solution isn't to ignore feelings, it's to acknowledge them and then act according to your predetermined system anyway. I literally say this out loud sometimes. I feel scared right now. That's okay. But my rule says to hold, so I'm holding. Separating the feeling from the action is where real long-term investing psychology lives. Let's talk about retirement planning for a second, because this is where System 1 absolutely destroys people's futures. Imagine you're contributing to your 401k, you're investing in index funds, maybe some target date funds, everything's going great, then the market drops 20%, System 1 screams, "Danger, protect your money," and suddenly you're moving everything to cash or bonds. Right at the bottom of the market. This happened to millions of people in 2008 and in 2020, and it'll happen in the next crash too. But here's what the data shows about capital market behavior. If you invested $10,000 in the S&P 500 in 1980 and never touched it, even through Black Monday, the dot-com crash, the financial crisis, COVID, you'd have over $800,000 today. But if you tried to time the market, if you sold during crashes and bought during rallies, you'd have maybe 200,000. Same starting point, completely different outcome. Why? Because System 1 convinced you to protect yourself at exactly the wrong moments. Here's where this gets really interesting for financial independence investing. The FIRE movement, financial independence, retire early, is built entirely on behavioral economics principles. These people aren't necessarily making more money than you. They're just designing systems that prevent their emotions from sabotaging their wealth. They automate their savings. They create clear rules about spending. They focus on metrics they can control. Savings rate, not market returns. They're essentially building a financial life where System 2 makes all the important decisions, and System 1 just doesn't get a vote. And the results? People retiring in their 30s and 40s with million-dollar portfolios, not because they're geniuses, because they understand cognitive biases, and they design around them. Now, let me tell you something that might surprise you. The biggest challenge in personal finance investing isn't learning what to do. You probably already know the basics. Diversify, think long-term, keep costs low, take advantage of tax-advantaged accounts like Roth IRAs. The real challenge? Implementing what you know consistently over decades. And that's purely a psychological game. It's about recognizing when System 1 is hijacking your decisions. It's about having rules in place before emotion strikes. It's about measuring success by whether you followed your system, not by whether you made money this week. This is why legendary investors like Warren Buffett succeed, not because they have secret strategies, but because they have the psychological discipline to stick with simple strategies even when it feels uncomfortable. Buffett talks about this all the time. He says the stock market is a device for transferring money from the impatient to the patient. What he's really describing, loss aversion and system one, thinking, destroying people who don't have systems in place. Let me give you one more practical example. Say you're building a diversified portfolio. You've got stocks, bonds, maybe some real estate investment trusts, some international exposure. In any given year, some of these are going to outperform and some are going to underperform. That's literally the point of diversification. But System 1 doesn't see it that way. System 1 sees the asset that went up 15% and thinks, I should have put everything there. And it sees the asset that went down 5% and thinks, I should sell this immediately. This is how people end up constantly chasing last year's winners, which statistically is one of the worst investment strategies possible. The solution? Predetermined rebalancing rules. Once a year, I rebalance back to my target allocation. If stocks went up a lot, I sell some and buy bonds. If bonds went up, I sell some and buy stocks. It feels wrong every single time. System 1 hates it, but it forces me to buy low and sell high automatically, which is literally the only way to win at investing. Here's what I want you to understand. The money you lose to bad investing decisions isn't going to market crashes or bad luck. It's going to investors who have better psychological systems than you do. When you panic sell during a correction, someone with a system buys your stocks at a discount. When you FOMO into a bubble, someone with a system sells to you at the peak. The market isn't rigged against you. Your own brain is. But once you see the game clearly, once you understand System 1 versus System 2, once you recognize mental accounting and loss aversion for what they are, you can build a financial decision-making framework that actually works. Not because you're smarter or more disciplined, but because you've designed a system where being smart or disciplined doesn't matter. The system makes the decisions. You just follow it. Look, I get it. Everything I just told you sounds simple in theory. But implementing it, that's where the real work is. Start small. Pick one rule and stick to it for 30 days. Maybe it's, I only check my portfolio once a week. Maybe it's, I automatically invest 20% of every paycheck no matter what the market's doing. Just one rule. Master it. Let it become automatic. Then add another. Over time, you're not just building wealth. You're building a psychological framework for financial success that'll serve you for the rest of your life. And here's the beautiful part. Once you have this system in place, investing becomes almost boring. No more stress about daily price movements, no more wondering if you should buy or sell, no more anxiety about whether you're doing the right thing. You just follow your system and let compounding interest do what it does best over decades. That's the real secret to wealth-building strategy that nobody talks about. So here's my challenge to you. Before you make your next investment decision, ask yourself, am I using System 1 or System 2 right now? Am I managing this money based on how it makes me feel or based on my predetermined rules? If you don't have predetermined rules yet, stop investing until you create them. I'm serious. Taking a month to build a solid investment framework will make you more money over your lifetime than any hot stock tip ever could. And if you want to go deeper on this, drop a comment below. What's the biggest emotional mistake you've made with money? No judgment, we've all been there. I read every comment and I'll reply with specific advice for your situation. If this video helped you see investing differently, do me a favor and share it with someone who needs to hear this. Because the financial education system doesn't teach this stuff, but it's literally the difference between retiring broke and retiring wealthy. Next video, I'm breaking down the exact portfolio management strategy I use, the specific percentages, the rebalancing schedule, everything. It's based entirely on these behavioral economics principles we just covered. You're not going to want to miss that. I'll see you there.